Reduce taxes from online revenue. Reducing your tax liability as a digital creator or online entrepreneur requires a proactive approach to categorizing your spending and understanding how tax authorities view online work. Whether your revenue comes from YouTube AdSense, Instagram sponsorships, digital products, or other online revenue sources, the goal is to shift as much of your gross income as possible into allowable business expenses. Strategic tax reduction for online creators. Maximizing equipment and technology write-offs. The foundation of any digital business is the hardware and software used to produce content. You can significantly reduce your taxable income by deducting the cost of cameras, microphones, lighting kits, and high-performance computers. In many jurisdictions, these are considered capital assets, allowing you to claim depreciation, such as the capital cost allowance in Canada, which spreads the deduction over several years. Furthermore, monthly subscriptions for editing suites, SEO tools, and cloud storage are often 100% deductible in the year they are paid. By maintaining a meticulous log of these purchases, you ensure that every dollar spent on your digital studio directly lowers your year-end tax bill. Leveraging the home office deduction. Since most online revenue is generated from a home base, the home office deduction is one of the most powerful tools for creators. This allows you to write off a portion of your rent or mortgage interest, property taxes, and utilities based on the percentage of your home used exclusively for business. For example, if your filming studio or editing desk occupies 15% of your home's total square footage, you can typically deduct 15% of your home-related bills. Even costs like high-speed internet and cell phone plans can be partially deducted, provided you can demonstrate their necessity for uploading content or managing social media accounts. This strategy essentially turns a portion of your personal living expenses into legitimate business tax breaks. Deducting marketing and promotional expenses. To grow an online presence, creators often spend money on digital ads, platform fees, and promotional giveaways. These costs are considered ordinary and necessary for an online business and are generally fully deductible. This includes Facebook or Google ad spend, the cost of hosting a website, and even the fees paid to freelancers like graphic designers or video editors. If you host a giveaway to increase engagement, the cost of the prizes, and the shipping fees to send them, can also be subtracted from your total revenue. Effectively, the money you reinvest into your brand's growth serves a dual purpose, increasing your reach and decreasing your tax liability. Business travel and professional development. The line between personal life and content often blurs when traveling, but legitimate business trips offer substantial tax savings. When you travel for a brand collaboration, a speaking engagement, or a creator conference like VidCon, you can often deduct airfare, lodging, and a portion of your meals. Additionally, the costs of professional development, such as online courses, mastermind groups, or industry-specific books, are deductible expenses. These investments not only improve your skills but also lower your profit on paper. It is critical, however, to keep a business purpose log to prove to tax authorities that the primary intent of the travel or education was professional growth. Strategic entity structuring and income splitting. As your online revenue scales, the structure of your business becomes a vital factor in tax efficiency. Operating as a sole proprietor is simple, but moving to a corporate structure, like an LLC taxed as an S-corp in the US or a CCPC in Canada, can unlock lower tax rates on active business income. Corporations often allow for income splitting, where you can pay family members for legitimate work, such as moderating comments or managing your inbox, thereby moving income from your high tax bracket to their lower one. Furthermore, a corporation allows you to keep profits within the business to be taxed at a lower corporate rate rather than the higher personal income rate. Consulting a tax professional to time this transition can save you thousands of dollars annually. Retirement contributions and tax deferral. One of the most effective last-minute ways to reduce your tax bill is through contributions to tax-advantaged retirement accounts. For the self-employed, options like a SEP IRA, solo 401k, or RRSP allow you to deposit a significant portion of your online earnings into a retirement fund, which is then deducted from your taxable income for that year. This is a double win. You are building personal wealth for the future while simultaneously shrinking the amount of money the government can tax today. Because these contributions can often be made right up until the tax filing deadline, they serve as a flexible lever to pull if your online revenue was higher than expected. To learn more about our law firm's technology business law legal practice, visit our website or contact our law firm to schedule an initial consultation. Thank you.